If you're an investor who has lent money to a company, but now you're kind of concerned that the company may default on its debt to you, you may buy a special type of insurance contract called a credit default swap. But today, investors are buying that default insurance on the US government itself. Not only that, but the price to buy that insurance to protect yourself against a US debt default has now spiked to a level that we haven't seen since the financial crisis. So why are investors today paying more for these credit default swaps? Good question. I'm glad you asked. First up, what is a credit default swap and how does it work? If you have children, you probably have life insurance. And if you don't, you need to go get some term life insurance today. The reason why you have life insurance is because you, as the parent to the children, provide the income that they need. But if something were to happen to you and you pass away, you'd no longer be able to provide the income for your children that they need to survive. And so you can purchase life insurance that will provide a lump sum of money that will be able to provide for your children in your absence. Now, here's the thing. If you're really old, and if you're really sick, and if you engage in a lot of life-threatening activities like skydiving and traveling around the world to dangerous countries, it will be very, very expensive for you to purchase life insurance because the life insurance provider understands that they've got a pretty high certainty that they're gonna need to pay it out. And so the cost of insuring against that loss of income for your dependents will go up or down depending on the perceived likelihood of actually needing it. A credit default swap is the exact same thing. A credit default swap is very simply an insurance policy that you purchase from somebody else that says, hey, if the United States defaults on their debt to me, then you're gonna have to pay me a certain number of dollars. The key thing to note here is that it is a third party, just like with life insurance. You're not purchasing this protection from the US government. It is financial institutions signing these contracts between each other. The financial institutions who are selling this insurance believe that they are being compensated enough and that the US probably will not default. But as that chance of default goes up, the people selling this insurance are going to charge more and more, and also the people buying this insurance are going to be willing to pay more and more. If you take a look at this chart here, you can see where we are right now with the price of 1-year credit default swaps on US government debt. You can see in the fallout of the financial crisis, there were a few times where the price of these credit default swaps did reach the levels we are seeing now. But if you look closer towards where we are today, you can see that it looks like these costs are more of a sustained rise and not just brief spikes. For instance, pretty much the last couple of years, we've seen the price of credit default swaps stay above the level that they were at in this lower range from 2008 all the way through 2014, and especially from 14 through 21. So the question is, why is the cost of credit default swaps surging right now? Well, the simple answer is obviously just that investors, both buyers and sellers of these swaps, are pricing in a higher likelihood of the US government actually defaulting. There's more demand for this insurance. And if you think this is stupid because a government can never default on its debt as long as it's debt in a currency that the government can print, don't worry, they actually can default here. And I will explain that in just a moment. The first reason why is because of the US government's budget deficit as a percentage of GDP. You can see during fiscal year 2024, it reached 6.28%. If we draw a line straight across at 6% for the last 100 years, you can see the only time it got worse than 6% was in the middle of World War II. Clearly, we are not in the middle of a world war right now, so the US government should not be running deficits to that level. And yet, basically, since the financial crisis, our deficits have been getting worse and worse. Again, this is as a percentage of GDP. So this is how much the government is spending in excess of what they're taxing compared to the size of the overall economy. So this is in context or in perspective, and it's still getting worse. But it's not just the deficit compared to the size of the economy. Currently, the United States total national debt is at 120% compared to our GDP. Again, the last time we were here was in the middle of World War II. This means our debt to GDP ratio is also unsustainable because, again, we don't have a war to just end right now. And then finally, when you take a look at the total federal receipts, in other words, how much money the US government takes in taxes as a percent of the size of the economy, you can see that basically since the 40s, this number really can't get higher. About the minimum the US government takes in taxes is 15% of GDP, and about the maximum it takes is 20%, but it usually stays even closer in between a range of 15 to 17%. The reason for this is very simple. If you increase tax rates, usually that slows the economy down, so the total tax revenue also goes down. If you decrease tax rates, that increases economic growth, which increases tax revenue, which means that either way, you are going to be taking a very similar amount of money compared to the size of the overall economy, which is why we've seen this number so stable throughout the decades, despite the fact we've had very different people in power, very different tax systems in place, very different tax rates in place throughout the years. So they can't tax more because that slows the economy down too much. They can't borrow more because at 120% debt to GDP ratio, that's causing interest rates to get too high to the point where it's more expensive to borrow. And with the deficit getting worse and worse compared to the size of the economy every year, you'd think the solution would just be to spend less. And for a while, that is what it looked like this administration was going to try to accomplish, but that has been thrown out the window now, as it looks like both Congress and the executive branch are pushing to spend like a drunken sailor just got introduced to cocaine. And this is why investors are suddenly paying so much more for default insurance on US government debt, because it's true, the US can actually default. Now, if you're not sure whether this is going to push markets up higher into a melt up or if it's going to cause a cataclysmic collapse, then I want you to save this date on your calendar, June 12th, it's a Thursday at 7 p.m. Eastern time, because I'm hosting a free live Zoom call where I'm going to be covering one of my favorite investing strategies for uncertain times, just like we're seeing right now. It's called the Black Swan Trade. This event is going to be completely different than anything I've hosted before. We're going to cover things like why some of the best hedge fund managers believe 2025 will be full of black swan events. I'll show you how I used this strategy to take home a 1,793% return in just 11 days during a market crash. I'll show you the difference between identifying black swans and gray swans, and how you can set yourself up to profit from either one. And I'll show you the details of 3 potential gray swans that I'm concerned about and watching right now. And plus, I'm even going to give away a signed copy of Nassim Taleb's book, The Black Swan. You can see it is signed by him right here. I don't know if you can see it on the camera, but this book is worth hundreds of dollars. I'm gonna give it away free to somebody on the call. All you have to do is sign up, register for the event by clicking on the link in the description below. Show up on Thursday, June 12th at 7 p.m. Eastern time. And as always, attendance is free, but spots are limited, so don't wait until it's too late. Go ahead and sign up now. I'll see you there. So why do so many people say the US government cannot default on its debt as long as they owe money that they can print? Well, in theory, that makes sense. If I owe you Joe Bucks and I am the only one with the monopoly on being able to create Joe Bucks, then how in the world could I default? All I have to do is go to my printer, print up more Joe Bucks, and hand them to you. It literally costs me $0. Well, unfortunately, in the real world, it's not actually just that simple. Now, it is true that the US government can print dollars. But in practice, the process is very distributed and it's not under the control of the US Treasury. The ability to create new money rests with banks who have banking licenses, and then that is backed up by the Federal Reserve. The Federal Reserve is given its power by Congress. And then the people in charge at the Federal Reserve are appointed by the president and then confirmed by Congress. So what does that have to do with defaulting? Well, the fact is that spending money is underneath the control of Congress. And that means passing the bill that details how and how much money they're going to spend. This means that if Congress doesn't come to a decision on how much money they're going to spend and how they're going to spend it, they actually can't spend money. And if they can't spend money, that also means they can't pay back money that they owe. This is why government shutdowns and spending bills always bring up the discussion of debt default, because if there is enough political gridlock, then defaulting on the debt would be something that would happen. Now, in reality, what would probably happen is there would be a temporary default, and then those treasuries would get paid back anyway, a little bit late. But the damage would have already been done by that point, point, and investors around the world would have been dumping treasuries like crazy. This would push interest rates sky high, which would mean somebody else would have to come in and buy up all of those treasuries in order to stop the global financial system from spiraling out of control. And that would be the Federal Reserve restarting QE. But at the end of the day, that is why investors are starting to pay more and more for this default insurance, because it is becoming abundantly clear to anybody who looks that the United States is on an unsustainable fiscal path. They are borrowing too much money, spending too much money, and the economy is not growing nearly fast enough to outpace the reckless and irresponsible spending by the government. And there are a few, not many, but there are a few people left in Congress that are trying to stop these reckless, crazy bills from getting passed to spend way more money, because Congress as a whole doesn't have the courage to do what is right and spend less, which means there's a growing non-zero chance that gridlock causes default. That is worth protecting against. Now, if you're wondering, okay, what are the implications for the average investor? Well, number one, austerity is gone. This was basically the one chance that I have ever seen that we might actually see this fiscal path turned around, and that got thrown out the window a couple of months ago. Spending will never stop, it will never slow down, it will never turn around, which means that assuming we don't have default, what we will see is an inflationary deleveraging. In other words, the United States, in conjunction with banks and the Fed, will print money in order to pay its bills, to pay back the money it owes, and to pay for its future expenses. This means prices will go up, this means assets will go up, and this means interest rates for everybody but the government will go up. So prepare accordingly. And if we do have the crazy event of a debt default, it means there's a lot of money that's gonna be running into things like gold, a lot of money that's gonna be running into things like Bitcoin, and financial institutions especially are going to be in deep, deep trouble if the Fed doesn't come in with a rescue bailout very quickly. Prepare accordingly. And again, if you want to know what I am doing to prepare for these uncertain events, don't forget to register for my Black Swan trade event. Link is in the description below. I will see you there. As always, thank you so much for watching. Have a great day.